everyone, and thank you for joining this Risk Conversations webinar, How Much Skin in the Game? Public-Private Solutions to Pandemic Risk. My name is Pamela Korn, I'm the Director of Communications at the Geneva Association, and I will be the moderator of our discussion today. As you may know, our Risk Conversations webinars are intended to present the findings of our latest research reports. And today we'll explore the findings of public-private solutions to pandemic risk, which I have here and which you can download on our website, risk opportunities, challenges, and trade-offs. And this was authored by my colleague Kai-Uwe Schanz. Kai is the Geneva Association's Head of Research and Foresight and Director of our Socioeconomic Resilience Research Program. He will give us an overview of the report and the key findings. Some of you are probably aware that this report on solutions follows a first report in our series on pandemics and insurance led by Kai, an investigation into the insurability of pandemic risk. This was published back in October, and we'll start our discussion today with a recap and update on the findings of that report in order to set the stage. I'm also pleased to introduce Paula Jarzabkowski, Professor of Strategic Management at Cass Business School at the City University of London. Paula and her team provided key contributions to this report on protection gap entities, or PGEs, and we're really happy to have her with us to take us through the different types of risk sharing and risk redistribution schemes, which have particular relevance to the UK, but also more broadly. Following the discussion of the report, we'll shift to what we'll call industry insights, with emphasis on different scenarios for how much skin in the game for insurers when it comes to pandemic risk, as well as other important considerations, such as whether the insurance should be mandatory or voluntary, the possible non-risk-bearing roles for insurers, among other factors. John Fielding, General Counsel in Government Affairs at Chubb, will share the details of Chubb's Pandemic Business Interruption Program and the discussions on insuring pandemic risk that are happening right now in the US. Ivo Metzinger, Managing Director at Swiss Re for Public Sector Business and Product Development, brings a practitioner's perspective as well. He was head of the Pandemic Pool Project, in which private insurers, represented by the Swiss Insurance Association, explored for the Swiss government's consideration how to better cushion the economic blow of another pandemic. He will tell us more about their proposal and where it stands. Robert Gordon is Senior Vice President of Policy Research and International at the American Property Casualty Insurance Association, otherwise known as APCIA, and he will share the results of APCIA's recent research on the economic impacts of the pandemic in the US and elsewhere, and how this informs APCIA's own position on PPPs, on pandemic risk, and the roles of government insurers. As you see, we have a varied and rich discussion ahead of us. We hope to have 30 minutes at the end of the session for Q&A, and we welcome your participation here. You can either raise your hand for verbal participation or type your question. And we will do our very best to address your question during the Q&A. And please feel free to type your question or raise your hand at any point in the webinar. So I'm glad now to begin with a summary of our recent reports on pandemic risks. I'll first return to Kai. So as mentioned, the Geneva Association's latest report on public-private pandemic risk solutions follows a first report on insurability of pandemic risks, which actually looked at business interruption, health, and mortality. But to set up our discussion today, we'll ask Kai to first present a summary and maybe also an update on that report's findings with regard to business interruption. So
Thank you very much. Thank you very much, Pamela. Hello, everyone. It's a great pleasure to share the findings of our most recent research report with so many of you. Let me kick off my remarks with a reminder of why we are having this discussion. The core or the root cause, if you like, is of course the gargantuan economic cost of hard lockdown measures, as well as the concentration of exposures among a relatively small number of economic sectors. This is highlighted by this slide here, which is taken from the OECD. According to a recent estimate from the OECD, the monthly bill in terms of lost revenue from hard lockdown measures is about $1.7 trillion for the advanced economies. $1.7 trillion per month. Compare this with the premium volume of the global property and casualty insurance industry, which is about 1.6 trillion in terms of annual premiums. And further compare these two figures with the size of the business interruption insurance market, which we estimate at a mere $30 billion. These three figures alone suggest that the provision of meaningful private sector capacity for pandemic BI risk is a very, very long shot. And this is further substantiated by the next slide, where we illustrate the capital requirements for a number of event scenarios as a percentage of expected loss. Let's start with the ideal setting for risk pooling at the left-hand side of this slide here. Ideal settings for risk pooling. This includes that loss distributions are known. It includes that there are no correlations between losses, to name the most important features. That leaves us with a relatively manageable capital requirement of about 50% of expected loss. If you enter uncertainty in loss severity, capital requirements jump and triple to a pretty uncomfortable level already of more than 150%. But the real game changer is the introduction of correlation in loss severity and loss frequency. So key features of pandemic business continuity risk, which push up capital requirements to truly prohibitive levels of up to 1,000% of expected loss, which is obviously commercially not viable.
Thank you very much, Kai, for setting the stage for us, and I think leading to the clear conclusion that there is an important role for governments here. So to continue on, it would be great to have an overview of our findings in the Public-Private Solutions Report, which set out a framework for insurers and governments to discuss partnership options. So can you take us through the four, what we call exemplary government-led solutions, and then, as we say, since there is no one-size-fits-all solution, there are strengths and weaknesses against different policy goals.
No, absolutely. And, you might conclude from the last slide, which I presented, that, the industry should walk away from the debate because at first glance, the economics speak a clear language. This risk is beyond our risk-bearing capacity, but I think everyone here on this call agrees that walking away from the debate is not an option for our industry. We have to be part of the solution. So we have to think very hard about potential approaches where we can get involved with government-led solutions. And that leads us to the next slide, which shows four archetypical forms of government-led responses that we have elaborated on in our paper, starting with direct insurance. So here we talk about the government-led direct insurance schemes, such as the National Flood Insurance Program in the US or the California Earthquake Authority, schemes where the private insurance sector has no skin in the game, but provides services and lends its infrastructure in areas such as policy issuance or marketing or claim settlement, for example. The second fundamental option, is a reinsurance backstop. So where the private sector has skin in the game, albeit at very, very low levels. So modeled along the response in the US after 9/11, so the Terrorism Risk Insurance Act. The third fundamental option, of course, is social insurance, so a mandatory universal scheme which is geared towards solidarity. And the fourth conceivable approach is, replication, if you like, of the policy response to COVID-19, which was the provision of ad hoc emergency relief and ad hoc safety net. So when judging these four options, I think a promising approach is to look at some of the major policy objectives, which they are supposed to support at the end of the day. And what is really striking, and you find all the details in the paper, is the significant number of severe policy trade-offs. This is illustrated here on this slide through the various colors and the contribution to the achievement of the respective policy objective. Just let me give you 2 examples. Let's take reinsurance, the reinsurance backstop. The reinsurance backstop is pretty effective when it comes to incentivizing for risk mitigation, because it is partially based on the private sector offering coverage on commercial terms. However, this scheme is not very effective when it comes to maximizing coverage across the economy, because the risk pool at the end of the day is likely to remain very small, or relatively small. Social insurance, another example for severe trade-offs. Social insurance is great when it comes to maximizing coverage. It's mandatory, it's universal, but it doesn't help in any way to incentivize for risk mitigation. So this illustrates the massive policy trade-offs that are involved here. And this leads to the key, to the bottom line from this slide is that you can argue in favor of each of the 4 options depending on the underlying policy priorities. Now, let us move to the final slide, please, with a summary of the key propositions. I think number 1, we have seen that the mismatch is striking between what we as an industry can bear and what the extent of the economic loss is. Remember the 1.7 trillion per month loss in revenues. Compare this with the 1.6 trillion total annual P&C premium volume and the tiny size of the global BI insurance market. Number 2, we have seen that severity and frequency in loss correlation pushes capital requirements to prohibitive levels, and that means that private sector capacity has remained elusive in the past and is likely to remain elusive going forward. Number 3, the third conclusion, and we will come back to this at greater length later during this webinar, any risk scheme has to depend on some sort of solidarity and some degree of solidaric risk sharing. We have seen from my initial slide that the exposure is concentrated among a relatively number of sectors of the economy. So there is a need for solidarity, either within a risk pool, within a pool of insured businesses, or across society, among all taxpayers, among all consumers. And number 4, very important, even if we have no skin in the game or very limited skin in the game, we can make a contribution to improving the effectiveness and the efficiency of future pandemic risk schemes. Remember what went wrong in the policy response to COVID-19, or remember the deficits such as an insufficient matching of the disbursement of funds, for example, with the needs of the most vulnerable segments of the economy. So there are many examples of where we can make a contribution beyond lending our balance sheets. Thank you.
Thank you, Kai, for this overview of the 4 generic types of solutions, and I think for really spelling out the fundamentals of what's catalyzing the need for these discussions and how we should proceed. I will now turn to Paula, whose team contributed as well to the Geneva Association report on pandemic risk solutions, particularly on how pandemic business continuity risk can be dealt with from a risk transfer point of view. So focusing on public-private partnerships and SMEs. Paula, can you tell us more about the risk sharing schemes presented in the report and what's being discussed in the UK?
Sure. So I think it's useful to start with what we already know about these types of schemes, because they tend to be the template that people turn to when we come to these types of situations. And our research has been looking at what we call protection gap entities around the world. Now, we call these protection gap entities knowingly rather than public-private partnerships, because although they all come about through some form of government legislation, they're not all public-private. Some are indeed fully private and some are fully public. So in that sense, but they are all bound together by the desire to address some problem in the risk transfer market and to keep making some sort of risk insurable. So I think that the first things are that they aim to bring global capital largely through the reinsurance market, so making reinsurance attractive to local insurance, but also through insurance markets to cover localized gaps in protection. So they're not designed to address something as systemic as COVID-19, but nonetheless they are helpful for us to think about. I would say that all of them are what we would call uneasy truces, meaning that they do come into play between players who wouldn't normally come together, governments, market stakeholders, different kinds of community groups. And so these people have very different objectives in what they want from protection and cover, different understandings of what insurance is, and very different understandings of the technicalities of pricing risk. So I think that we need to expect that these things will never be smooth sailing, although they can be very long-term and very effective. And to give you just some idea of the main two reasons why they come about, and you may know of these two in the UK, pool re and flood re, they typically come about to either resolve disruption in supply, so something where there's been a catastrophic shock to the market and the private market withdraws capital, maybe for the long term or maybe for a short term while it works out what to do. This is usually when its own modelling has been shown inadequate to some sort of secret risk on its books. And pool re is an example of that, coming about actually in 1993 in relation to the terrorist bombings of the Baltic Exchange, after which terrorism insurance was no longer available for businesses in the City of London. And without terrorism insurance, in the event of such high levels of terrorism activity, it wasn't possible to continue, for business to continue. The other problem, and I think it's one that's more of a slow creep, but one that is on us in many situations now, is the problem of unaffordable insurance as legacy assets, householders and businesses are in areas that have become more at risk over time because of changing environmental conditions, changing planning conditions. And so the insurance prices rise and it often becomes unaffordable, or certain groups fall out of the insurance pool. And under those circumstances, we see things like what's happened in the UK with flood re, which is a means of addressing potential unaffordability of insurance for those who are in now what could be considered depleted flood zones. And if you just go to the next slide, I'll show the two main strategies that occur in managing these kinds of risks. So there's two key strategic responses that a PGE can take, or that a government can legislate for a PGE to take. And so the first is removing risk, so taking that risk from the insurance industry and from the consumer and putting it either onto a PGE's balance sheet solely. The California Earthquake Authority in the US is an example of that, where the risk is removed from the insurance market altogether after a disruption in supply, and it's kept within the California Earthquake Authority, who then negotiates with the global reinsurance market. The more extreme form, if you like, of removing risk is to remove that onto the balance sheet of a PGE, such as pool re in the UK, but also to provide either a capped guarantee or an unlimited guarantee, as is the current case for pool re, from the government balance sheet. So you get all the mechanisms of insurance, but with government capital sitting behind that. Now, that removing risk situation is good because it can happen very fast. You don't have to wait to tempt capital back to the market. You don't have to work out how that capital might be applied to the market quite so clearly, because if it's going to be particularly government backing, then government capital probably would have come into play in some way or another anyway. It's this time going to come into play specifically through an insurance mechanism. So they're quick to set up when there's an immediate disruption in supply. And they're very good for highly volatile risk, where it's difficult for the insurance or reinsurance market to know how much capital, or to need to put a sort of pricing premium on the uncertainty, such that you might only get a small amount of global capital attracted to this without some other backup. There are some weaknesses in this and there is no perfect solution. So I think we need to accept that when you remove risk from the primary risk traders, the insurance market, you weaken their risk appetite. They're no longer modelling it. They're just picking up the premiums and passing them through to other bodies. And so that weakens their own innovation, their own inability to understand and retain that risk. And that risk may become less volatile or more tame over time as we get to know more about it. The other thing I think that we need to be careful out of these mechanisms is that they can take the most volatile risk and put that on a government balance sheet. But actually, insurance isn't about just taking the volatile risk and leaving the rest of the risk for others to take up. I mean, insurance is a diversification play. So we do need to be careful that these kinds of things don't skew volatile risk solely to the balance sheet of the government, whilst leaving the market free to take other forms of risk that are less volatile. On our horizontal axis, we've got another strategy, and this is called redistributing risk. And I think Kai, to some extent, alluded to this in the sense that we need a broad pool of premiums to smooth the pricing of high-risk areas. And this is what typically comes about when we have something with a problem with affordability. One of the ways that you can smooth pricing is to charge some form of levying across the full pool of insureds, and that way you redistribute the high cost of premiums for those most at risk across the premiums of the many. And so it's really recreating a sort of solidarity approach, even when risk-reflexive pricing has taught us that some areas are very high risk. It's particularly good where you have a nationalised approach to the insurance market or to the reinsurance market sitting behind it. I think CCR in France, with its both the breadth of the perils that it covers and also the percentage of the personal lines that it covers within France, it's a very good example of how that can work to smooth the pricing of risk. One of the challenges that we're seeing as we get more growth in these high-risk areas, though, is that this is based on a principle of the premiums of the many paying for the losses of the few. But when we're getting more areas of high loss in different areas or greater concentrations, then we have to consider, are those premiums of the many sufficient? And also, are they being fairly used? Because to some extent they do mask price signal. And is that a fair and wise thing to do under growing risk? The other thing that we need to think about is that it does shift the focus from risk mitigation. If you can get a subsidised premium, there's less incentive perhaps to mitigate risk. So that's what we know about how to do this. Let's change to the next slide and just have a think about how that's worked in terms of solutions for the UK. I should point out that only one of the solutions I'm about to present to you is actually in effect in the UK at the moment, but all of these have been or are currently being considered. It's been a very short space of time that we've had this pandemic. Even the most extreme speed at which we've seen PGEs developed is 12 months. And so we really just about had a little over 12 months, even if we were to come up with a PGE for something as extreme as COVID-19 or as pandemic. Nonetheless, the first scheme, and I think it was a very laudable scheme, was where the insurance industry decided to pool together across each other in order to be able to offer something to policyholders for business interruption, SMEs. The idea of that at the time that the pandemic broke out is that they could quickly, if they created some pooling between the insurers themselves, do a private market solution, at a price to policyholders. It was pretty quickly apparent, although that's a redistribution strategy across them, that wasn't going to be possible with the scale and the scope of what we were looking at. The second solution that came up, and I think it's one that still bears further investigation and thought, is that it would still remain a private sector solution, which would be an insurance-led PGE, and that SMEs could claim against their current losses with the idea that they'd be buying into a 15-year premium. And so they would be paying off the cost of those losses or the cost of that premium, that elevated premium, over 15 years. So rather than one big premium in the first year, you could sort of, allay the balance of the costs over 15 years. Again, I think that has some interesting features in it, but of course it's very contrary to the way that insurance works, which is largely annually renewable. Certainly we haven't seen 15-year premiums or policies and contracts. And so the way that this was going to work, even so that it's a redistribution mechanism both across policyholders and across time, was going to be that the government would have to provide a guarantee for default on those premiums. And we need to keep in mind that businesses can fail in 15 years, regardless of a pandemic. And so there are a lot of risks that you get exposed to there. I think the third and fourth solutions, they're largely the same solution, but one is very much about saying, look, these things are too wild, these systemic risks. But insurance, as Kai pointed out, does have certain features that it can play in pricing risk, in removing risk. So it could be the front for premiums across policyholders, but then the government would provide the backstop. And this would either be defined event, something very specific like a pandemic, very tricky there in terms of exactly what is the event and the definition of event, as we all know, because of, the ongoing nature of this particular event, and also what's the trigger. Is it a government lockdown, or is it actually a disease, or a contagious disease? But nonetheless, this would be a possibility. The other is what is called an open event, which means maybe you don't have to define as precisely exactly what the risk is and what the trigger is, but that you come up with some idea of a parametric type solution of under losses of X amount to businesses from something that is defined as systemic, the government would then provide an immediate cash injection to allow those businesses to keep moving. But of course, the businesses would have had some skin in the game because they would have paid a premium in the first place. Now, with both of these, I think there are many risks, but they are probably the most realistic solutions in terms of any way to bring capital to an insurance mechanism to something as catastrophic. Nonetheless, I think there's something we can also learn from two what I would call partial or stopgap solutions that have come up in the UK and that are actually currently working between the insurance industry and the government. This is film and TV, which was actually brought about by the film and TV industry, going to the government saying we can't keep running, and the government deciding that it would provide the support for that. Some discussion with the insurance industry, but basically deciding to take all forms of COVID-19 disruptions onto the government balance sheet so that film and TV could continue. The other one, which is trade credit, came about in another way, in that the insurers came to the government and said, trade credit will be exposed under these circumstances. We could work with you to come up with some sort of backing for this. Now, I think it's important for us to learn from both of these. The reasons they were able to come about very fast is they're very discrete and very defined. While there's very different amounts of capital backing both of them, it's not the magnitude of the capital, but the discreteness and the definition of the risk which the government feels comfortable to come into. And also the other thing I think is that it looks like there's an apparent exit strategy for government, so it's not something that's permanent. Nonetheless, I think that they provide us with some very useful ways to think about why did these come out so quickly? What other types of risk could we, for example, at the moment, there's a lot of discussion about live events and how that might be dealt with under a similar mechanism. So if we just go to the next slide to conclude, I think that we have learned a lot about what's available through PGEs, and there's a lot of information about that. Those mechanisms probably provide some useful blueprints, but a systemic risk is always going to have a government backstop as well as government legislation. And at some level, we're going to have to consider that should be mandatory, because if the government provides the backstop, then it's not fair that some people are able to get the government backstop because they bought into it, and others get government support anyway, whether they chose to protect themselves or not. So what we're talking about is a real shift in culture and understanding towards risk sharing, and that's not just sharing between the insurance industry and the government, but also across consumers. So it's a different dialogue about how insurance happens within the public and private sector. So hopefully that's given some thought, some food for thought.
Thank you very much, Paula, for not only defining risk redistribution and risk removal, but offering these concrete examples and themes that are going to come up, I'm sure, in the rest of our conversation right now. I suggest we move to the industry insights portion of our discussion, starting with John from Chubb. So Chubb, based in the US, has developed a pandemic risk proposal for consideration, and he will first talk about the underlying rationale and key considerations for developing the program. Over to you, John.
Thanks very much, Pamela. You can move to the first slide. So, I just want to talk a little bit about why we've sort of engaged to find a solution. As Kai sort of discussed earlier, COVID exposed this protection gap, business losses from the pandemic and government shutdowns that aren't covered by insurance, because the severity, correlation, and systemic nature of the risk. Pandemics create losses so great that they're not insurable in the traditional private market. So the federal government, well, in the U.S. anyway, but the governments across the world really need to take the lead on this. They've got to be the primary player because only they can really afford and have the resources to meet the needs. But at Chubb, we really believe that although the federal government clearly must play the main role, there's an important role for insurers as well. Not only can the industry have a risk-bearing role in addition to an administrative role, which we're really good at, but the industry should have such a role because its participation can provide not only monetary support, but benefits in terms of improved behaviors, risk mitigation, pricing, underwriting, things like that. And we think those contributions are very important. We think if the federal government can establish guardrails and create a sensible program structure that limits the risk we're assuming, which is essential, the insurers can play the risk-bearing role that can contribute and have a positive impact. So my colleagues put together this framework to get that I'll talk about in just a minute, really to get ideas on the table, encourage the debate, to encourage stakeholders to getting towards a sort of a workable approach that includes industry skin in the game. And we think that any program that includes industry participation, really, there's sort of 5, sort of key attributes. And the first is a meaningful role for the industry to share pandemic risk for the government. Sort of as I alluded, we think it's important for industry to participate in the solution, and not just as a service provider, because industry involvement can help drive better behaviors. Over the course of time, we think industry will develop valuable risk management and risk mitigation knowledge and experience that can lead to better understanding of pandemic risk mitigation, preparedness. And then industry capital, skin in the game, can also provide an opportunity over time for increased private sector risk sharing as direct and secondary markets develop, and hopefully reduced somewhat anyway the government's pandemic burden. We think also that over time, governments will we will understand pandemics better. And with our participation, that can also lead to reduced burdens. Second key attribute is a structure that meets the different needs of small, medium, and large businesses. We've learned that the pandemic doesn't impact all businesses equally. It affects small businesses differently, and it's much more challenging for them really from the get-go. Pandemic programs should recognize and respond to different circumstances in a pandemic for small businesses, many of which face immediate shutdowns and limited financial resources. They just don't have the liquidity, they don't have the more sophisticated risk management that larger businesses have. And so we really think that there needs to be a different approach for small versus medium and large businesses. The third attribute is really affordability for small businesses with a strong incentive to purchase coverage, but having a choice as to whether to purchase that coverage. And 2 things really come into play here. First, the premium for the pandemic BI coverage has to be affordable for small businesses, and this will likely require a substantial government subsidy. Second, in addition to affordability, there needs to be strong incentives to encourage purchase of coverage by small businesses. And we think that this should be in the form of what we call a strong opt-out, where businesses that choose not to purchase coverage are essentially disqualified or not eligible to receive government assistance in connection with future pandemics. The fourth attribute we think is essential is really effective incentives for broad participation by the industry itself. So a BI program has to be structured to attract broad participation to get as broad a market penetration as possible. So different markets with different profiles and risk appetites. And then finally, the program has to be fiscally responsible. And we think a public-private program is fiscally responsible if it's carefully created ahead of time with clearly defined mechanisms, triggers, and benefits. And we think it's going to be less costly and more efficient than sort of an ad hoc, post hoc government relief program. We can flip to the next slide. So in putting together a program, there's really a number of key questions that we think need to be answered to structure it. How much total protection should the government provide? What should the program limits be? Should the industry bear risk or just administer a program, which we sort of addressed? How much risk should the industry take on industry-wide and on an individual insurer level as well? How should premiums be determined? Should government charge a premium for its portion of the risk? Are they subsidized, the premiums? How are they subsidized? Who's covered? Small, medium, large businesses, and how are they covered? Is there mandatory offer, required offering of the coverage, mandatory purchase, required purchase, or voluntary? What are the individual policy limits? How is the program triggered? How are claims adjusted, parametric or traditional claims adjustment? And also, how should reinsurance and excess coverage be addressed? So those are sort of the parameters and sort of the broad strokes that we looked at in putting together the program. If you want to go to...
Yes, please go ahead into the details of the proposal now. Thank you.
Sure, I'd be happy to. So our program is bifurcated. It's really the sort of essence of our program is to address small businesses differently from large businesses. And so we've got a two-part program, the first being the Business Expense Insurance Program, the BIP, which serves small companies, small businesses with fewer than 500 employees. The BIP policies are issued would be issued as an endorsement to an existing workers' comp or business owners policy. It'd be mandatory offer, so all insurers that offer business insurance, such insurance, would need to offer the pandemic coverage. Purchase by businesses, by policyholders, would be voluntary, but again, it would be a strong opt-out, kind of like I described before, where if a policy of business does not purchase pandemic coverage, they wouldn't be eligible for other government relief. We think that with this sort of strong incentive plus the premium subsidy from the government, there would be really high take-up rates. We are pretty confident in that. The policy limits would be 3 months of payroll, plus operating costs like leases, utilities, things like that for certain classes, depending on how the business is structured. There'd be a 14-day waiting period following declaration of a pandemic, so the businesses would have to plan ahead to cover 2 weeks of the shutdown, give them some skin in the game, some risk mitigation there. The claims would be paid on a parametric structure, a simple claims process, so to provide clarity and certainty, and an accelerated claims process too, so the policyholders know what they're getting and when they're getting it, they can count on it, which is really important. And one of the distinguishing factors, we think, between small businesses and medium and large businesses. Policyholders would pay premium only on the risk covered by private insurers, not the government. So the government's portion would be completely subsidized. The program limits would be $750 billion. The industry share would be $15 billion in the first year, moving up to $30 billion over the life of the program. And then the individual company shares would be, a company would fund 6% of first dollar claims up to the company's market share of the industry limit, that being $15 billion in the first year. And then moving to the pandemic reprogram, which is for medium and larger businesses, that is businesses with over 500 employees. This is really more like a standard reinsurance program, really. It's an indemnity-based program in which both the insurance industry and the government are paid an appropriate risk-adjusted premium for the coverage. Participating insurers retain a portion of each risk and then reinsure the rest to Pan-Re. It's a voluntary offer and voluntary purchase. So this is really just an additional resource for medium and large businesses to the extent they need it. There's no government subsidies here. Businesses will purchase the coverage, if it makes sense financially. It utilizes a traditional claims handling process, not parametric. Again, more in the traditional insurance sense. The policy limits up to 3 months of expenses with a maximum of $50 million per policy. And the reason we put a $50 million per policy limit here is because we wanted to ensure that a few large companies wouldn't take up, most of the limit of the program. There's a waiting period of 30 days or longer is determined per contract. The program limit is $400 billion. Again, with the industry share of $15 billion in the first year rising to $30 billion over the life of the program. An individual company would fund 5% of the first dollar claims until the industry limit is reached. So those are the two programs. The qualifying triggers are the same with both programs. That is a government declaration of emergency. It meets the medical criteria of a pandemic, lockdowns being enforced. And importantly, neither would cover COVID-19. The loss payments, the payments would be made through a line of credits from the Treasury Department, and both the government and industry would pay first dollar claims. So that's really it in a nutshell. I'd be happy to answer any questions.
Thank you very much, John. I think we have a trend going where first we are talking about the thinking behind the various options and proposals, and then going into the details. And moving on to Ivo, I suggest we stick with this framework. So Ivo was part of the working group, led the working group on the insurance industry side that was mandated by the Swiss Minister of Finance to come up with a proposal for insuring pandemic risk. So perhaps, Ivo, you want to first talk about how the working group approached the concept of PPEs more broadly, and then go into your involvement in the process. Thank you. We may have lost Ivo. Okay. He may be having technical difficulties, so we can...
Can you hear me?
Oh, yes, we can now. Great.
Okay, so the typical mute-unmute challenge.
No worries.
All right. Pamela, thank you. I want to take one step back first and just share a few observations from a practitioner's point of view before I then go into these specific Swiss discussions. So obviously I completely endorse what everyone has said in terms of the limits of insurability, that the systemic risk cannot be insured in the private market. So we need the government, and the government needs to bear the majority of the risk, but we can still play a very useful role. And something that resonated with me very much from my experience with discussions of governments that Paula said, which is the uneasy truth. So nothing of this, establishing a PPP or a PGE in Paula's terminology, is easy. Very different stakeholders. The political economy plays an important role. But if I look at what the proposals in various jurisdictions and countries have revolved around, it's actually a mix of the different archetypes or type of solutions that Paula mentioned. Most of the discussions involve actually a very limited amount of private sector capacity, simply for the fact that the counterparts in government wanted some skin in the game from the insurance industry. But in order to address some of the disadvantage of that model that Kai presented, of where the government essentially reinsures, was a low penetration. And in order to address this, in many discussions, the dimension of a mandatory cover became quite central to the proposals. At the moment, many of the discussions actually have lost a little bit of momentum, since on the one hand side, governments have turned their attention again to managing the emergencies, the second and the third wave, so very little capacity to continue with the dialogue. And at least equally relevant, most governments have turned to providing money for free to support enterprises. And that has obviously, let's say, dampened the demand and the voice of potential beneficiaries. Why should they, pay premium going forward if ultimately the government provides money for free? So we need to reignite these discussions. I expect that there will be more or less formal lessons learned discussions in all jurisdictions, and better preparedness, including financial preparedness, need to be part and parcel of these discussions. And I'm absolutely convinced that we can all do better than just relying on ad hoc organized financial support through the general taxpayer. And the last observation before I go into the Swiss dimension and example is these schemes are never designed for eternity. I remember Julian Anoisi, CEO of Pool Re, for instance, a good friend of many of us. He always shares the experience these schemes evolve. So may they start with, for instance, no industry involvement, and industry involvement can grow over time, similar to what John suggested in its example. But now to the discussions in Switzerland. I think in contrast to many other discussions and ideas that were floated in Switzerland, the finance minister mandated a joint working group, so really from both the government and the Insurance Association, to work out proposals. That working group worked between the May and September last year, submitted a report. The government then started a survey amongst enterprises and enterprise associations to determine demand. And actually relatively recently, the Federal Council put the discussions on hold in one of its last meetings on the 30th of March 2021, mainly with the argument that the survey of enterprises and enterprise associations has not provided evidence for very strong demand. I think that doesn't come to a surprise to many, simply because there is a lot of financial support that comes for free. And once you've crossed that Rubicon, I guess, demand will not be loud and clearly voiced. In terms of the proposals that we've come up with jointly, there were several of them. And I will be talking mostly about the preferred option from the insurance industry's point of view. I've provided here an illustration. I think the key, one of the key dimensions was we want to create a separate vehicle where we see capital, so premium capital funds accumulating, because that you can show, point to that fund that's being accumulated, which is ultimately to the benefit of the beneficiaries, so the insured, rather than having it be hidden in the balance sheets of individual insurers. So we propose to create a separate vehicle where actually premiums would be accumulating. That vehicle is then reinsured essentially by the insurance market as well as by the government. This vehicle had a maximum liability depending on the scenario between 10 to 15 billion Swiss francs. You can turn to the next slide. So this separate vehicle would be actually a mutual reinsurer, which would be owned by the insurance industry. It focused on covering pandemic. And in terms of the trigger, I think in Switzerland, we have a relatively clear-cut situation in that there are very specific laws and legislation in place of when, under which circumstances the government can actually mandate lockdowns, for example. So we would base the trigger on these, on the declaration of these specific situation, followed by an appropriate authority actually then mandating the lockdown. We had a long discussion about should it be for SMEs only or all enterprises. We came to the conclusion it should be all enterprises, including the self-employed. One of the reasons I think Paula also mentioned it, we cannot just exclude a certain segment of the economy and not offer anything to them. And it should also be for those affected by direct mandated lockdown as well as the indirect impact. In terms of the insured interest, we really focused on the fixed costs that are not covered by other government support systems. In most of continental Europe, you have the Kurzarbeit, so short-term working arrangements. So the focus was really on the fixed cost not covered by any other government support system. Similar to the proposal from Chubb, all insurers would participate mandatory. We spend a lot to actually adjust this, because if you have a comprehensive scheme, you're suddenly faced with, even in the limited market of Switzerland with 300,000 claims at the same time. It needs to be really highly automatized, and the solution we've looked at is similar to a Taggeldversicherung in Switzerland. So per day of closure, you have a predefined sum insured. All of this is pre-funded through premiums. We differentiated a little bit according to industry type, because obviously different industry types are exposed to a different extent to a lockdown. And the government proposed that it will charge for its portion of the risk it takes, but it will limit itself to the pure risk premium, which we stipulated as 3%. So, a lockdown, a pandemic, including lockdown every, 33 years or so. We're very important, mandatory participation, because otherwise, we have the moral risk, obviously, and those enterprises which choose to, risk for the event, the event to happen, and then the government would bail them out anyways. If we turn to the next slide, that's my last slide. The most pertinent discussion items with the government were actually, the mandatory nature of the cover. Paula has touched on it. Which it is an important feature, but it's also a controversial feature. The government as the main risk taker, and the fact that the government identify, the lack of a clearly articulated demand from enterprises. We've then moved forward to also float a few alternatives to address some of these critical and controversial issues. In the Swiss scheme, the government was really foreseen as the reinsurer, acting as a reinsurer. Similar to the UK, for pool re, the government could also just be, provide a contingent credit, which would then be paid back over time. That would ultimately change the nature of what the government is and how much risk the government actually runs if the government is being paid back. And another idea was if you really have to get around the mandatory cover, what about looking at an entirely different nature of where individual enterprises would actually start essentially saving, to a predefined sum insured that they determine themselves, and that the government would provide for the difference between this target capital and the actual capital in the savings account were an event to occur before sufficient funds have been accumulated. As I've said, and I'm closing there in terms of the next steps, the better financial preparedness really needs to be part and parcel of a thorough lessons learned process. The current approach of making it up as we go is simply not good enough. And I'm convinced that we can all do better to be better prepared for the next systemic risk to occur. Thank you, Pamela.
Thank you, Ivo, for all of the details on the proposals that you worked on and discussed with the Swiss government. We're getting a few requests to receive the slides after the webinar is over, and everyone who has registered for the webinar receives the slides and will have access to all of this information. So rest assured. We will now move on to our last intervention before the Q&A, and I am conscious of time. We have about 20 more minutes left altogether, but we still hope to have time to answer some questions from the audience. So you please submit your written questions or raise your hand, and this will come up very shortly. So I'll turn to Robert. Robert, of course, is with the American Property Casualty Insurance Association. And so we have another US perspective to offer today, in addition to John from Chubb. So Robert, we have discussed specific pandemic risk insurance proposals for the UK, for the US, for Switzerland, with different roles for governments and insurers. Now in the US, there is the Terrorism Risk Insurance Act, otherwise known as TRIA, which created a U.S. federal backstop for insured terrorism losses. So from your perspective, could a government-backed insurance program like this work for pandemics, and why or why not? I know you have some deep research that APCIA recently conducted to share with us that underpins your position on this topic. Thank you, Robert.
Well, thank you, Pamela. And I was actually the primary congressional staff counsel working in the House of Representatives back in 2001 creating TRIA. But I'll tell you, terrorism is a fundamentally different risk. The perils that resulted from the terrorist attacks on September 11, such as fire and explosion, those were property coverages that were widely insured before 9/11. And it was just the magnitude of losses and the motivation behind the attacks that was the problem. But again, it was still physical property damage, and the losses were in the tens of billions. In contrast, the pandemic business interruption has been largely excluded in the United States. There's never been significant coverage for macroeconomic plunges in demand, which is what we're seeing right now with the pandemic. COVID-19 losses have been ongoing for over 13 months globally with losses of trillions of dollars. But I really want to go back to what Ivo was saying about you need to analyze the lessons learned here. Our members are in the business of managing risk, and when feasible, we do generally prefer a risk management role. But as much as we want to view everything through an insurance lens, insurers just are not in a position to solve every societal problem. You can only commit capital responsibly on a broad scale for risks that meet the basic tests of insurability. We'd suggest the question perhaps should not be how much skin in the game, but rather what losses do pandemics cost and which ones of those losses are well suited to insurance. So in the United States, trades representing over 90% of the market, along with some agents and brokers, joined together to develop the Business Continuity Protection Program. That is a federal solution that uses a pandemic trigger, timely, effective, affordable government relief. But frankly, we've learned a lot of lessons since then, and some of the initial assumptions that the marketplace has haven't necessarily held. So we always believe in working with our members and the industry to try and together understand what is the problem that we're trying to solve. And we're about to publish an economic analysis of the impact of COVID. I just want to highlight some high-level takeaways from that. First, the pandemic losses have been far more extensive than any past catastrophic event. We're talking in the tens of trillions versus tens of billions from the largest previous loss, Hurricane Katrina. And any of these proposals trying to force trillions of dollars or tens of trillions of dollars in coverage on the industry are going to cause failures. We've also identified 8 specific categories of pandemic risks and losses. There's the macroeconomic instability, the record unemployment, the liquidity and cash flow for businesses, particularly as they try and shift to a remote workforce, solvency threats in some sectors, event cancellation, liability protection, and then, of course, the enormous health and mortality losses. And those are all distinct risks, and insurance is not necessarily designed to be a solution to all of those. One of the most important scientific findings about COVID is the United States Center for Disease Control recently confirmed that COVID-19 is not generally transmitted by surface contact. And they found that surface cleaning is only recommended if there's been known COVID exposure in the last 24 hours, and it can be easily cleaned with soap, detergent, and disinfectants. That was corroborated by the Journal of American Medical Association finding COVID infections for frontline health workers were consistent with the general population, not correlated with their work environment. We've determined in our analysis that most pandemic losses were caused by a plunge in macroeconomic demand, consumer demand for in-person services, not the result of physical damage, not the result of government closures. So just for example, dry cleaners in the United States were allowed to remain open. They were considered an essential business, but their revenue dropped 83 to 92% in the early months of the pandemics. U.S. airlines, similarly, essential businesses open, their revenue dropped 96% initially, and even at the end of the year, we're still 45% down. So we now understand, contrary to our initial thinking, the business continuity losses occurred not because of physical damage or closures, but because consumers were no longer willing to risk being in close proximity with other humans. So in other words, again, a plunge in demand for in-person services. If you look at the next slide, it compares the previous one, actually, sorry, if you go back one. It compares the gross domestic product in the United States with that of Germany, which had a very strict lockdown, and Sweden, which did not impose any lockdown at all. And what you see there is Sweden enjoyed a slightly better economic experience initially than the United States, while Germany's experience was somewhat worse, but the overall economic experience was largely similar. The next slide compares the American states that had lockdowns versus the 8 states that did not. The lockdown states had only slightly worse economic performance, but they were of similar magnitude in both the initial losses and the slow recovery. We have corroborating evidence now, a study by the University of Chicago Journal of Public Economics that found overall retail traffic fell 60% in the pandemic, but the civil authority government closures only accounted for 7 of that 60%. And the retail visits decline was primarily tied again to fear of infection. The COVID losses were very unevenly distributed in the economy, something Ivo noted. The peak losses, if you look at this next slide, peak losses were overwhelmingly concentrated in the leisure and hospitality sectors. And there's a study being performed by some of our colleagues analyzing the U.S. Paycheck Protection Program, found that applications and grants for relief by sector were actually not correlated with which sectors had the greatest business losses. So simply put, while the program provided some very essential relief, the money was not allocated to the business and the people that needed it the most. Our APCIA analysis suggests that the commercial sector suffering the most harm and unemployment, such as the leisure and hospitality sector, they also have a highly disproportionate number of low-wage minority and female employees. So the important takeaway there is that any government relief, rather than being this broad scattershot approach that's been discussed, really needs to be better targeted. We're concerned that private insurance would have to charge the highest rates for the in-person services that are the most impacted by the pandemics, but those may be the most critical for the government and the economy to keep open. And good public policy suggests that the programs directed and made the most affordable to those in-person service industries, because they tend to be low-wage jobs, it would provide the greatest economic stabilization and preserve the greatest number of jobs in the most vulnerable populations. There's been a lot of discussion about the importance of insurance for mitigating losses, which first assumes that somehow the government doesn't do any mitigation of losses, which we have dozens of federal agencies in the US and at the federal level and at the state level doing that. But in fact, the primary mitigation businesses have used to reduce their losses in this case in the pandemic is terminating employees. And that's particularly happened in the leisure and hospitality sector, where the employees are disproportionately low-income minorities. Now, mitigation by terminating low-income employees, it might make theoretical sense for insurers and policyholders to save money, but it's completely contrary to the public policy goals. The next slide shows the unemployment rate in 3 countries with mild lockdown, strict lockdown, and no lockdown. And this is, we've looked at a number of states, but didn't want to clutter the graph too much. But government lockdown policy had surprisingly little impact on unemployment. Unemployment's really impacted a lot more by labor restrictions. Again, going to the point, this isn't about government closures. It's not about physical damage. It's about a macroeconomic plunge in consumer demand for in-person services. The next slide similarly compares employment in U.S. states with lockdowns versus those without. You can see the states that without lockdowns had somewhat fewer jobs lost, but still a very overall similar pattern. In our APCIA white paper, we also look at states that were in lockdown but open early versus those that stayed locked down for much, much longer. Little bit of benefit from lifting the quarantines early, but again, clearly not the dominant influence on employment losses. So how do these findings update our thinking about pandemic relief? Well, policymakers and the industry have largely focused prospective pandemic programs on providing broad business continuity protection and trying to sort of shoehorn it into the business interruption line. But again, business interruption Insurance coverage is a property coverage. It's a property coverage, and there is no property damage here. Insurance has never covered shifting macroeconomic consumer demand, and it's not well suited to do so. And we hear a lot of stakeholders trying to pretend that because both involve a business losing money that you can somehow fit the two together, but they're fundamentally separate concepts. It's kind of like saying insurance should be forced to offer hedges against economic growth declines. That's not a typically insurable risk. Bob Hartwig and I have published 2 papers comparing pandemic risk to the 6 factors that are usually necessary to have all of them for insurability, and the broad COVID-19 risk doesn't meet any of those 6 tests. The pandemic losses are too systemic, too correlated, impossible to adjust millions of simultaneous claims. You can't accurately model them with respect to the shifts in consumer demand. And it's too expensive to provide affordably, given the unknown frequency. We don't even know what kind of mutations of COVID-19 we're going to have. I know there are a couple of the very largest insurers who are not as dependent on reinsurance that have suggested for the right price they can offer anything in very limited quantities, but that ultimately doesn't suggest those shifts in consumer demand are broadly insurable. Again, no different than saying you can put a box around economic hedging and offer it. We're also very concerned that if you try and force a public-private partnership, it's going to destabilize markets because there is no available pandemic reinsurance. All that means is most of the carriers aren't going to be able to responsibly provide coverage, and they're going to have to withdraw or contract their offering in that underlying market, which can be create a very anti-competitive effect. So to the extent that there is a government-focused program created, we really think it needs to analyze separately these different 8 risks, trying to match which solutions make the most sense for some of those. We do think there are some that are more suited for insurance, like liability risk right now. There's communicable diseases being broadly excluded, but there may be an approach, an insurance approach for those risks. We also do continue to support the Business Continuity Protection Program, but it's clear now that we really need to start, as Ivo mentioned, with understanding the problems. Understand the problems, match up the solutions appropriately, and we now have extensive evidence from our lessons learned that there are many critical economic, broader macroeconomic problems that insurance alone can be appropriately designed to address. I'm happy to, once we're done, to take questions.
Thank you very much, Robert. So we are nearing the end of the panelist discussion portion, but I do want to give everyone on the panel an opportunity to react to one another. So we've now had 5 different interventions, and so maybe we take 1 or 2 questions among yourselves before we turn to the audience. And if there are none, then we turn to the audience. Okay, there was one technical question from the audience on Chubb's program. Someone had asked, what is the target loss ratio for the Chubb's proposed program? I'm not sure if you have that information handy, John, or if you want to follow up with this.
I would. Thanks, Pamela. I saw that, and I was actually looking a little bit while Robert was talking to see if I could find it. And I'm sorry I can't find that, but I will try and get back to you, Pamela, and respond.
No worries. Thank you very much. Well, I think it would be interesting to talk about risk mitigation. So we had a question from the audience, and some of you may have already seen it, about what to do kind of outside of insurance from a risk absorption point of view to educate the public about COVID-19 and about vaccines, and how do we see the role for insurance here, which actually crosses over into the political arena a bit. I'm not sure if anybody has views on this, if insurance has a role to play there.
Pamela, if I may start, Robert Gordon with APCIA. We just had a great discussion with the Federal Insurance Office on the Federal Advisory Committee, and Munich Re came in, and Oliver Wyman came in, talking about how important it is for the government to start collecting and gathering the right information for policyholders in the industry to make more informed decisions. And that's something that policymakers haven't really spent a lot of time on, but right now everybody's flying a little bit blind. And so much of this information is distributed in so many areas. But if we could start to better understand exactly where the unemployment is coming in, which hospitals are first hit by the pandemics, how that changes and evolves, how it grows, some of this data collection could be very, very important. So there's a lot the government can do there just to help us better understand the problem and make better decisions.
Pamela, maybe I can come in here too. So first of all, really important that it was raised, the relevance of prevention and intervention, which is, led by governments, is absolutely critical. Dealing with the financial outcome is only third in line or fourth in line. So, having a pandemic preparedness plan on government level, but then also an individual enterprise level is really important. Having all the protective gear in place, et cetera, et cetera. Switzerland has all of this. We have a national risk registry. Pandemic is right up there. But not everything has, completely worked out as, we had expected. So there are lessons learned. So these roles are extremely important. What can we contribute from an insurance industry's perspective? So on the one hand side, obviously we do have the relationships with enterprises. So helping them with the appropriate preparation, prevention plan, emergency plans, it could be one dimension. The other dimension is obviously we're reasonably good. I would like to believe in terms of data analytics and analysis. Swiss Re is participating in what is called the Trinity Challenge with a number of academic institutions where we help provide tools that allow actually quite interesting analytics in the sense of how have the infection rates, for instance, developed, how have they reacted to various intervention methods, and by simply collecting the data actually from a very large set of other stakeholders and using a visualization engine, you can even test it out on our website. So there are analytical, I think, contributions we can bring to the table too.
Thank you, Ivo and Robert, for your responses. We are only a few minutes out from the end here. I wanted to offer all of the participants an opportunity to give 1-minute closing remarks. We can improvise, or if Paula, if you have any closing remarks to offer.
Yeah, I think that it's the set of presentations indicate to me a couple of things. One is that this is a complex problem to resolve, and secondly, that there are very different national context understandings of how that might work. I value the data that we've seen from some of our colleagues showing us what they understand about where losses came from and whether those losses are necessarily something that's an insurable loss. So we've looked at a whole raft of financial measures just to keep economies afloat. I think it's really valuable to understand what are the specific things that are driving losses for businesses, because those then could be some of them insurable and some of them not. But I think that even underpinning all of that are quite different approaches to how the relationship between the state and the market are seen in relation to the approaches that might be developed. So I think we probably need to understand that there will be no one size fits all, even if the effects of a pandemic itself and the way that it transmits and the way that we mitigate it are the same. How that will be dealt with in terms of an insurable solution could be quite distinct in different countries, depending on how much they place primacy on, freedom of the market or, the role of the government in intervening in the market and so forth. So I think that's something for us all to consider further as we face more of these systemic risks. What should that relationship look like in different contexts?
Thank you, Paula. I think if any of us took anything away from this conversation, it has been that context is critical to deciding the right way forward. Kai, would you like to make any closing remarks?
Very, very quickly, I wanted to come back to the notion of solidarity, which to me seems to be at the core of most of the discussions we had. You know, what we learned from the pandemic is that, yes, there are many, many losers. There are sectors of the economy who suffered badly, but I think we also had some surprising findings on who actually benefited from the pandemic, and quite handsomely. Some sectors really benefited from the pandemic. So from an economic point of view, there should be scope for collective risk sharing, for collective burden sharing, because the impacts of the pandemic need to be viewed, in a very differentiated way in order to avoid premature conclusions. Thank you.
Thank you very much, Kai. Ivo, do you have any last comments? He's on mute.
Just needed to unmute myself. I think Robert brought in an important point, and I just close by re-emphasizing this. I mean, we have really very much focused on what, at least in a European context, is the elephant in the room, which is the business interruption. There are so many government support, luckily, so many government support systems in place, for instance, to address unemployment. But we should also reflect on all the losses and financial contributions the insurance industry already contributes, be that with respect to travel, credit, liability, mortality, health. This is significant. Our estimate is the total bill for the insurance industry will be from COVID-19 around 50 to 80 billion US dollars. This is a significant contribution, and the insurance industry is set up to cover these, has the appropriate risk management, scenario planning, etc., in place to deal with these exposures, and we have earned premium for it. So these are functioning and working, right? We are really focusing, I think rightly so, on the elephant in the room, which is the business interruption.
Thank you very much, Ivo. John, would you like to offer comments?
Sure. Just to say that I think that we have learned so much in the last year, plus a couple months on this, and things and we're continuing to learn to see what the impact is, to how it's impacted the economy, but how it's impacted the insurance sector. And I think coming at it, as we've seen from different angles, is actually going to be quite helpful. I don't know where this will end up in terms of the public-private partnership or how we will address the next pandemic. But I think that the process that we've got going is actually a good one. It's a little messy right now, but it's actually a good one. And we'll hopefully end up with something that makes things less messy the next time around.
Thank you, John. And finally, Robert, please.
Thank you, Pamela. First, I agree with my colleagues. These are very complex problems. It's very important to fully understand the lessons learned. Again, I think understanding and sort of peeling the onion of the different kinds of losses is very important. And you probably need different programs tailored to the different losses and to the different sectors, since we now know that they have had dramatically different experiences and different social consequences of the losses impacting those sectors. Most of the industry focus has been on business continuity, but we now know that the business continuity losses resulted primarily from a macro plunge in consumer demand for in-person services, not property damage. And insurance is not designed to hedge against shifting consumer demand risk. So you really have to think about matching the problems and the solutions. And again, we talk about mitigation, but the biggest business expense that we've seen, and the biggest form of mitigation over the last year, was terminating low-wage employees. And that's not necessarily good public policy. Again, something you have to think through as you match up the solutions. Insurance might be better suited for some of the other risks, and insurance in some cases can certainly be a distribution mechanism and provide important expertise, and we're making every effort to do that. You also, though, don't want to try and force these solutions into the insurance system, because you risk contracting and limiting the underlying markets and doing more damage to your competitive structure than good. So we hope that there's good dialogue, good understanding of these programs, and appreciate the great work that the Geneva Association has done, and look forward to continuing to work together.
Thank you, Robert, and thank you to all of our panelists. Something Ivo said really stuck with me, which is that it's really important right now to reignite the discussions. With the pandemic is still with us. Now is the time to take the lessons learned and to make sure that the dialogue is sustained. So we hope that this webinar contributed to that effort. I want to thank everyone for tuning in. We had a very nice size audience today, and thank you for all your questions. And please join us for future risk conversations webinars this year. Thank you very much. Goodbye.
Thank you, Pamela.
Bye-bye.
Thank you.
Thanks, everyone. Bye-bye.
Thank you.